By the way, the project one is due. So anyway, so this is much easier version of project one. So let's look at this theory for income, how to use income statement. So let's look at this. Let's look at this. This is a graph here. So let me explain what does the idea. What's the idea behind it? Um, Let me give you an example. So uh, let me give you an example. So let's say Apple sold a product with Microsoft. They don't buy it from each other. Let me just make it a hypothetical example. Okay, let's just say Apple sold 1 million product to Microsoft. So the contract, the sales is $1 million. Let's say the profit is $1 million. So
Yes, Professor.
what's the example about is what we found is the contract can be repeatable. So which means next year the Microsoft and the Apple, there's a 40% of chance the contract, the 1 million contract will be signed again.
For the theory driven, I have a theory here.
That's the pattern we
whether
actually,
the theory
that's the
actually
theory we
makes
have.
money.
So
Only
if that's
test
the
that.
case,
You
one
cannot
question
just
I ask you
cannot
guys
just
is,
tell people saying,
when Apple
this
signed
is
up
correct. You
a
have to
contract with
empirically
Microsoft with
test
$1
it
million,
to show people this is
would
correct.
you consider the
So let's
contract
look at
is
the
$1 million,
methodology
what we will have here,
when you
which is very
evaluate
important
Apple,
for you guys
or
to
you
do
consider
the
as a $1.4
replication
million
project.
when you
So
evaluate Apple.
we have Excel project, right? We have 5
That's my
replications.
question.
So my question is, if
this
you
is
know the
important
contract
for the project,
so
will
let's
be
look at the
40%
what we
of
are
chance
talking about here.
renewed
So
next year.
so let's
So
say
when
the
you
idea
evaluate
here
the
is
value,
say
the
you want to
stock price
predict
of
the
Apple,
return in
would you consider
2012. You want to
the
predict
contract
stock
value
return
as $1
2012.
million
So what do
or
you need is
$1.4 million
you use the
when you evaluate
250
Apple?
variables
We
up
should
to this
supposed to do
period
$1.4
to
million.
predict
If we
the
know
stock
for sure
price in
there's a
2012.
40% of chance the
So
contract
that's
will be
what we
renewed
want.
next
You
year.
cannot
Does it make
use the
sense?
information from the
Does
2012
it make sense?
to
Is that tricky? Sounds
in your
tricky?
model to predict 2012
Okay, so this is the theory behind. This is
return.
theory behind.
So
what we're
so
testing
and
for
this is a rolling process. So what do I mean by rolling
we can
process?
calculate
So here is
the
can you guys see my
likelihood of the
mouse?
contract
Like my moving mouse? Can you guys
will
see
be
that?
renewed the next year, which is 40%.
Can you
We
guys
want
see?
to test whether
When I move
other
my
people
mouse?
know
Okay. So let's
the
look at
40%
this.
of chance
So
of
let's say
renewing
if we want to
contract.
predict
If
return
everyone knows that,
from this period,
that means what?
from
If
2010
everyone
to
knows that,
2011,
that
so
means
what do?
everybody will
So you
consider
use all the information from
1.4 million
2009 to
contract
2010
instead
to
of 1
predict
million
a
contract.
return
If
in
everyone
your
knows that,
2000
okay.
in the next
If
period.
nobody
And
knows that,
do the same thing.
then
When you want to
then
predict
doing
the
the
return
evaluation,
from
everybody will
2011
consider
to
$1 million
2012,
contract
you use
instead
the
of 1.4.
information here to predict
So
the next period.
So
So
is
you
the
always use
question
the
is
historical
the setup clean
information
here? So
to
basically,
predict the future returns.
so
So what does that
if
mean?
everybody know
What
the
I mean
contract
is,
will be
so let's say
renewed,
going back to my
40%
earlier
chance
example,
next year.
if you stand in
Everybody
here,
knows that.
let's say you
Then
just stand
everybody
in here,
will
you
put
stand in
$1.4 million
a T plus one,
value
you stand in this
valuation
point.
for Apple.
If not,
You
you
will
can
put
use
1 million.
all the
So we want
past
to test
information to
that's the
predict future
information
price.
we know.
However,
Also,
you
other people
cannot
know.
use the future information
we
to
want to test that.
predict future
I
price.
tell you
That
the
would be
results. The
considered
results
as
is
cheating. That would be considered
only
cheating.
people,
And the
not
example, one
everybody know
example
that.
is
We
like
found
the
people only
national
evaluate
entrance exam.
1.2 million
You have
into the
to
contract.
you have to test.
So basically,
You have
there's
to
a
do the
large
test first,
portion.
and then you check with the solution.
There's a
You
22
cannot
million
get the
portion are
solution
not
first, and then
incorporated
use the
into the stock
solution
price.
to
So
go
what
to
I
test
was
the
saying is
national
entrance
the
exam.
other people,
You
the
cannot do that.
investors. So
Only
this is the
consider
so when you
1.2
do
million
the
contract value
when we
for
do the
Apple
testing,
instead of
you have to make
1.4.
sure
So
the
that's
model
why
you
we can
use
form the
has to
trading
be
strategy.
historical.
That's why we can
The
form
model
trading
variable you
strategy
use,
here.
the 250
So what do we do
variables I was
here?
talking about,
Here is
has
look at
to
the
be
formula
past
here.
information,
What is the
and
formula?
that predicts the future returns.
Is
You
the earnings,
cannot use
is the earnings,
future
and
information
you can
in
consider
your
as a
model in
contract.
order to predict
And this
future
is the
returns.
next year
Otherwise,
contract.
we consider
So
as a
we
cheating.
first run the
So this
regression.
is one
First
thing.
run the regression.
And
One
we are doing
regression,
rolling.
we get
The rolling is because
we get the
we are using
coefficient
this
here.
information
What kind of
to
coefficient
predict
here
next
is
period,
this is the
and then we use
0.4,
this information
which
to
means
predict the next
every
period.
dollar
And then we use
contract
this
we have
information to
here.
predict next period. So
There's a
if you see, this
40%
is a
chance
rolling
the
process.
contract
Keep
will be
rolling,
renewed next year.
So this is a
every
0.4.
year you have
And
to
the next,
rolling
what do we do is
that
to get the
hello?
next year's return. So this is one thing I want to
Yes, Professor.
discuss with you guys. When
So
you do the
so you can
replication,
understand
remember
SUE as a
using the
contract.
past
So
information
every
and
$1
not
contract
future
here,
information.
the next year will
There's
be
a lag
point
between the
four. So means
information in your model
every
and the
$1
future stock
contract, there's a
returns.
40%
This
of
is the first
chance
thing I
will
want to
be
emphasize. The
renewed
second thing
next
is,
year.
like I
And
said
then we want
earlier,
to test
I made
whether
investors
40% of
know
stock
about
returns
this
this year.
40%.
How do we
So
know
we use the
the
SUE
stock return I
to
made
predict
this
the
year
next year's
is
return.
the return.
So
The idea here
from
is
my
if
skills, or
everyone
it's
knows
written from
the
risky,
SUE
my luck,
can
my
predict is
random gambling.
40%,
So how
then
do you
we
don't know
don't
that?
see any
So
abnormal
you have
return
to adjust
because
the
this is
return. You have
the
to adjust
future
the
period.
return
This is the future
for
period.
some stuff. So for example, the simple way
If
is
investors
you
do
use
not
your
know the
return minus
40% of
market
chance of
index.
renewing contract, then
So
the
what does that
SUE
mean?
will
So
predict the future
what's
abnormal return
the
since
market
this is
index
future.
next year
So
for
let's look at
Nasdaq?
the graph here.
It's
Let's
about
look at the graph
30%.
here. So if you
So
look
what
at the
I
graph,
gain is
if you look at the
40%.
graph,
The Nasdaq
so
index is
let's
30%.
look at the
So what's my actual gain?
what's my
long
gain
and short?
over the
I
market
don't want to make
index?
it too
10%.
complicated for you guys. Just
So
look
I
at the
would
long
say the
side.
10%
For
is
the
my
long side.
skill. So this
Because
is
I
time
can
T,
beat the
right?
market by
Time
10%.
T, we have the
If I
contract
can
announced.
keep doing that
So
again and again and again, that means
what I want to
I'm
say is
always
if
win the
everybody
market by 10%.
understands
So you cannot just
the
take your
nature of the
return as
contract,
a return. You
then
have to adjust something.
the
Here
stock,
is the
the market
index.
reaction will incorporate
index.
the contract
And then the second one is
for
there's a different way to
$1.4 million.
calculate.
However, because the
Calculate,
market only incorporated $1.2 million in the
different
time
to calculate the abnormal
so
return.
the rest of
Another way is the size
$0.2
adjusted.
million
What does the size
will be
adjusted mean?
gradually
You guys learned that.
impounded
So
into the stock price
smaller
over
firms
T plus one
normally
and the
have
next earnings
higher
period.
returns.
So
Because the risk
so that's
is
the
higher.
idea for this
The
project.
bigger
So
firms has
basically
lower
the
return.
idea
So
here
what
is
does this
the
mean
idea
is
here is
you use the raw return like 40%.
during the time
If my
T,
40%,
the investors
my
only
40%
understand
return
are all from the
smaller
smaller
firms.
contract value.
I have to
They
use
miss
the my raw return minus
contract
the
value.
return from the
So,
smaller firms.
but
The
over
difference
time,
between
they
two
gradually
is
learning,
my
gradually
skill.
learning.
My
So
skill.
over the
So that's
next
another
3 months,
way to adjust
they gradually learned that
returns.
the point
The
two
third
million
way
dollars
is not just by
it's
size.
also
Size
can
and book to
be
market.
renewed.
So
They learn the
basically,
information can be
I
renewed.
use my raw return
You can
minus
gain
a
like
portfolio of
$0.2
return,
million
which has
profit
smaller size
from trading in
and
the
also
future
low
period.
book to market
So in
value.
other words,
So
let me just
you
repeat
can
this
adjust
one
for
more
that.
time since
So
this is a little
the
tricky
three
here.
measures.
So what's the
in other
intuition?
words, intuition is you cannot
if
take the
investors
raw return as the
evaluate
return
this
you
contract
You have to
by
use the raw
$1.4
return
million,
minus
you will not
some
predict
return
anything in the
that
future
can be generated
because
from
everything has
risky
been
investment.
incorporated here. The reason
Or
why the
market.
SUE can
So for
predict the
example,
future
here,
stock returns
why a
is
minus
because
market?
they only
Because market is,
incorporated
if you
$1.2
do
million
nothing, you can get
in
the
the
market
time T,
return, right?
and the rest
So
of
you use the raw return
$0.2
minus
million
market.
will
The
be
difference will
gradually
be market
impounded
adjusted
into
return.
stock price.
So why
is that
you use the raw
logically?
return
I know
minus
this is
size
this
adjusted?
is
Because
some little bit
because
tricky part,
smaller
is
firms
that they are risky.
logically
They already have higher return. So
one
you
more
have
time,
to
I
use
just
your
want
raw
to say,
return
minus
if everyone
the portfolio
understands, if
return
everyone
from smaller
understands
firms
the
in order to
persistence
get the
of
difference.
SUE,
The
if everyone
difference is your
understands
skills.
the
The
$1
same
million
thing applies
contract
to the third returns.
will
So
be
that's how you
continuing the next
calculate.
year. If everyone
That's how you
evaluate the
calculate
contract
the
as $1.4 million,
abnormal returns. The
the
fourth one
SUE
is
will not predict
the
future return
fourth one
because
is
every
fact
information
adjusted.
is
It's
very
understood
similar to
here.
this.
The
The
difference is
reason why
the
SUE can predict the future stock
here is use
returns
the raw
because
return
there's a
minus
proportional
size adjusted
information
return.
missing.
But here you use
Investor only
regression
put
to get the
$1.2
residual.
million.
You use
The
regression to get the
$0.2 million
residual to get
contract
alpha from
are
the
not
model.
incorporated in a
So
timely
the
fashion
idea
at
is
the time
similar.
T.
Idea
So
is you have to get the raw return minus some
future time,
risk
so you can
benchmark
trade
return.
on. That's the idea.
So basically, you
But the
know
difference
something
here
other
is
people
here
doesn't know.
you
Here
use the raw
at the
return
time T,
minus. You know
here
something
just
other
use
people
the
doesn't know.
minus.
So
You
you buy
minus
the stock.
risk benchmark
And
return.
over time,
But
when
here
other people
you
learn
use
about what
regressions.
you know,
You
and
use
the stock price
regressions
go up,
and
you can gain a
use
trading profit.
regressions to get
So
the
basically,
residual.
that's the idea.
The residual
Okay?
is same.
That's the
It's
idea.
a risk adjusted
So
return,
basically,
and
just
that's the
last
abnormal
time I
return.
just hope you can
So
get.
for this
So
class,
basically, at the
you
time
will
T,
learn how to
you
view
know
the
something
market,
other people
this
doesn't
one,
know, which
and
is
also
you
fact
know
adjusted return.
the value
So
of the contract is
this is in the
$1.4
project
million. You know
replication
something
project.
other people
In
doesn't
the
know.
project, I will
And
have
then
you guys
buy
to
the stock.
calculate
And
the
over
market index
time,
return,
other people
how
will
to calculate size
gradually,
adjusted
slowly
return,
learn
and also
that
factor adjusted
the
return. These
contract
are the
is
three things
worth
you will do
more
in
than
the project.
$1.2 million.
So you can
In a
gain the
paper,
profit
I
because you
wrote
in
trade
very detailed way
ahead of
how
other
you should
people,
do that,
and
how
you
you
can
can
gain
gain
the
the
trading
very.
profit
So
from
you
the
just
from the
follow the
from the
follow
future.
the
So
follow the
that's the
material I sent you
that's
guys.
the
You will calculate the
that's the one
returns using
example
the way.
how you
So the
understand the
idea here
income
is
statement by
I
using the
gained
persistence
40%
of a
this year.
contract.
Doesn't necessarily
And
mean this is my skill. You have
and
to
another
take
thing
out
is
the
you have
risk
to make
components,
sure
the
you have to make
difference.
sure
That's your skill.
the
That's
profit
the
is
idea
not
here.
from the transaction cost.
And
When we buy
and
stocks,
also
you buy
in
and
the
sell.
project, I
There's a
want you guys
spread.
to
When
do
you buy and
Farmer
sell, the
Mac
bid-ask
regression.
spread
So
will
what does
consume
Farmer Mac
a lot of the
regression
trading
mean?
transaction
So
cost.
looking at this
So
graph,
what you need to
so
do
each
is
year
you have
want
different
to
trading
take
profit,
take
right?
care of the
So in
transaction
earlier
cost.
years, it's
So you
low,
want to
high,
see
low,
the
high,
stocks,
low, high,
the
low,
stocks
high.
which has
So
low
every
transaction
year,
cost
the trading
can
profit
also
is different,
generate profit.
right?
So Farmer Mac best is the
So that's the
average
idea.
of
That's the
every
idea.
year's trading profit. That's the to just take the average. That's Farmer Mac
So
best.
basically, the
So
idea here is
what?
that
So in
here
concrete
you
way,
want to
what
make
does that
sure
mean? That
you
means
know
in
something
the
other people
2009 you
doesn't
run
know, so you buy the stock.
one regression.
And over
In
time, when
2010
other
you
people
run
start to
one
realize
regression.
what you
In
know, you
2011
gain profit.
one wrong
Here,
regression.
you want to make
2012
sure
one
the
regression.
profit
When you
can
average
cover the
out
transaction
all
cost.
these annual
You don't
regressions,
want like you
that's called
gain
the Farmer Mac best.
a one
The purpose
1%
of Farmer
3
Mac
days.
best
If
is
the
you
transaction
don't
is
want a
also
certain
1%,
year
you
to
gain
drive
nothing,
your
right?
results.
You want to make
want
sure
your
the
results
profit
is driven
you
by the
obtain from the
time
trading
series
strategy
pattern
can
over the
cover the
returns.
transaction
So
cost. That's
that's the
actually
Farmer
the
Mac best
that's
regression,
actually
which
the
you guys will learn.
that's
Also in the
actually the
project
idea
you
we
guys
have.
need to do.
So this is the test
Let me
we
just
have
say
now.
one more
You
time.
can see
The
that
Farmer Mac
the
best is
strategy what you
every
have
year
is
you run regression.
about the
Every
3 day
year
return
you
is
run regression. After you run
0.7%.
regression
This
every
is a
year,
pretty
you
high.
average out all the
So
annual regression
over the
into
3 months is
into a panel
6%,
regression. That's called
6%.
the
So what
Farmer
does that
Mac
mean?
best.
That
The
means
purpose of
if you
doing that
buy and
is you
hold,
don't
if
want
you use this
some
strategy,
year
buy and hold
drives the
3
results.
months, it's
You
about
want average over the time
6%
series
for 3
pattern
months.
of your
And then if
trading
you do
profit.
3 days, it's
So
about
so that's Farmer Mac
0.7
best regression. You guys will do
0.71% for
in a
3 days.
project.
I
So
told you guys the importance of doing 3-day return, right?
another
So
important question
so what
I
I'm
want to
saying is,
ask you guys
if you buy the stock here,
how do
and
you
over
know
from here to
the
here
40% of return
is
is
6%,
from my
and
skill
over the
or
3
from the
day
risk
here
gambling?
is
So in other
0.71%.
words, is
Let me repeat it one more
this
time. If you
40%
buy stock
return
here
kind
and
of
over from here to
repeatable?
here,
Like
3
I
months,
can gain
you
40%
gain
this year, next
6%.
year. So
If you
this
only
is a
buy the 3
fundamental
days
question
here, if
for
you only
all
got buy and
the
hold 3 days
when we
here, it's
analyze the data
about
for manage the income
0.71%.
statement.
So that's
How do
pretty
you know
high.
the 40%?
I told you guys
How
the
do you know the
importance of
40%
doing a 3-day return,
is
right? The importance is
it's
3-day return is less risky. It's
it's
less risky. If you can
it's
get
repeatable.
profit from
It's by
3-day
skill,
return,
not luck.
it probably
So there's
shows that
several ways.
you can
There's
generate
several ways to
good
do it.
trading profit.
I want you guys
So it's
to
about
understand this, and
so
also
this is
this is
about
important
the
for your
trading
project
strategy
as
is
well.
about
The first one is to
6%,
adjust for risk. That's what we did here, right?
6%,
You minus size
6%
risk
for
factor. You
the
minus
3 months
market
buy
risk
and
factor.
hold.
So the first thing is once you
0.71%
adjust all the risk, you still have
for the
positive
3 day.
profit.
So
And
this
that
is a
means
transaction here. So
your
basically, what
return
does
is
that mean?
from the
This
skills,
means
not the risk.
if
Does it
you
make sense? So for
consider the
example,
transaction, if you
once
adjust for
use
transaction,
your
the
raw
return will
return
be even
minus
higher.
size adjusted,
So
if
here,
the return is still
you
positive,
add
that
them
means
together, so
you are
11%.
gaining something.
So
You are
if
beating
you
the
take
size
out the
adjusted
transaction
returns,
cost, you can
right?
get even
So
11% for 3
that
months.
means after
Here
adjust
it's
for
about
size
1.3.
or
You add
everything
them
risk,
together.
if you still
zero
have
point
positive
0.7
return,
add
that
0.6.
means it
You add
looks
them
like
is
positive.
1.3.
But the one
So
problem
basically,
is
the idea here is if you
there's a
consider the
concern is
transaction
you
cost,
don't know
the
what are the
return is
risks here.
even
So
higher.
we only just
It's
for
even
size,
higher.
book
So
market, liquidity,
so that's the
momentum.
idea of
Maybe there's like a
idea
1
of this
million risk out there. You don't
of
know.
this trading strategy. So basically,
You don't know. So
basically the
see, I'm
first
saying this.
is
So the
you can
problem
gain
is when you want to
return
adjust for risk,
by
is some
if you understand the persistence of
unobservable
the
risk
contract.
there.
Other
You
people
can
don't
never
understand it.
adjust for.
That can give you the
I don't know if that
6%
makes sense for you guys.
3
So
months
you
and
can only
0.71
adjust for
over
risk
3 days.
that
And
is
if you can
observable for you.
consider
But you
transaction
can
cost
never
into the
adjust some
model,
risk.
and
You
the
never
return
see.
is
For
even
example,
higher after
COVID-19. This is
what
a
you
risk
take out the
you
transaction
never see
cost. It's
until
almost
it
double.
appears.
It's about
Until
11
it
months,
appears.
3 months, about
So
1.3.
how can you adjust to some risk?
About
You can
for
never
3
even
days. So
find them.
this is the
So
trading
so we
strategy
have to work around that issue.
one example I was talking about. So this is always you guys should do the annual day. You can see from 2008,
Which means
from
just
2008,
adjusting for
how
risk
stable
is
it
not
is.
enough.
So you can see the
Because there are many risk
the profit
factors
you made.
we
The
maybe
green
we don't
one
know.
is the
We have to
combined
do
strategy.
more than
You
that.
can see
So
that
what we should do? Several
it's
things
pretty high
first,
over time. You see,
if you can
it's
generate
always
profit
above
from
zero, right?
short-term
Always
window
above zero.
than
In
long-term
2008,
window,
there's
we are
some
more
there's
confident
some
it's
crash
still
on the 2008.
not
So
not
basically,
not
if you follow the
not
trading
by luck.
strategy, you
So for
only
example,
you only
if
get
you can
something wrong on the
get the
2008.
return
Other
from
than
3 day
2008,
window
over the past
versus buy
like
and
20
hold for
years,
a
it's
whole
pretty
year,
good,
we
right?
will
It's
think
pretty good. So this
the
is
profit is more
over
tradable. The
time,
reason
the
is because
performance.
the
So when we
shorter
do
the
Farmer
window,
Mac best,
the
that's what I
less
said. You have to
unobservable
average
risk.
out annual
So
effect into the
if
Farmer Mac
over the
best.
one
That's
year,
earlier I
you
was
a
talking
lot of
about that.
things can happen. So You don't know
So
this is
another thing
driven
is the
by the
quarterly
your
return.
skill
So
or
this
by
is
the
annual.
risk.
This is 3 day.
But in
I'm
a
sorry,
short
this is
window,
3 day.
in a
This is
short window,
quarterly.
because
So
this
basically,
3 days, only three
this is
days.
3 day
What
return
can happen in
from
3 days? It's
2088 to
just
2008.
six
You can
months,
see that
right? Plus
every
two
year you
years.
make money
So
except 2008.
just this is a very short time.
And
If you can get
look at the
1%,
quarterly. You
in
make
the three
money
days,
almost
that
every
means
year.
really good. That
Not
means you are
almost.
making profit. If you can get
All
like
every year.
if you only
At
get
least
like
the minimum is 5%. You
12%,
see,
annually,
minimum is
only
5%
buy and
from
hold
the
for the whole
2000
year. It's
from
very risky.
1987
The
to
longer you
2008.
hold,
So
the more
most
risky
of the
events
years,
will happen. The
you're
more
making
unobservable
money on
risk
that.
factors
So
you will
this
have.
is the
So
one
this
thing
strategy
we will do
is
is very
if you can
classic
generate
trading
return from
strategy
short
using by
window,
hedge
it's
funds.
good. That's why in
It has
all
been
trading strategy, we want to do short-term window test.
so it has been
You
a
can see
while.
all the
So
papers I give you guys, all the trading strategy I
so
give you
what I
guys.
want to tell
You
you
have to
guys is
generate return from
the
short-term
red
window
line
in order to
is a
convince
classic
people
trading strategy
this
used
is
by hedge funds.
this is by
But the green
skills.
line
This is not
is
by
the
luck,
strategy I
not by
invented.
risk.
So
So this is one point I want to
basically,
raise.
I adjust for the after I adjust for the transaction cost.
Another
The
point I
classic
want to
trading
raise
strategy
is
was double.
you want to
And
see the
here you can
decline
see that
pattern over year.
you can
So
see
let's
that
look at this
the conventional model.
table.
You can see that it also makes
So
money.
this is
The green line is
this is a
my the
project.
strategy I created. I
This is
also
a
use that.
paper I give you guys to read,
Some
but you don't
investment
have to
firms
read
also
today.
using my trading
So,
strategy
but
too. Now the
it's
strategy
one of
even
the
new.
project.
I
So
developed the trading
the
strategy
operating
in
growth,
2011. So
it's a variable
2011. So
calculated from
basically,
balance sheet. You can see
the
that
red
the
line is
operating
the
growth
classic one.
can predict
Everybody are
next
using
earnings
hedge funds.
announcement return
The
3
green
days.
ones
It's
are the
about
ones
0.4%
I developed.
3
So
days.
basically,
So basically,
I take care of the
over
transaction
3 days,
cost.
you
The
can earn
profit will double.
47
So it's
basis
on the
points.
3 days.
It's pretty
like
high.
on a quarterly
Only
basis. You
3
can
days.
see that
That's a 3 days
quarterly
return,
the red line
right?
is the
That's a
trading
3 days
strategy
return.
classic
That's
one.
very
The
high.
green line
Oh,
is
okay,
the
in the
one I
next
developed.
quarter, so
And
this is
and
and the
you see
three
the profit
3 months
is
late 3 months
better.
later,
So
the operating growth can predict about uh, uh, 31 basis point. And 3 months
yeah.
later,
So
again, after 3 months, there is no
yeah.
return. There's
So
no
this
return.
is the
So why we want to see the
so this
declining
is the
pattern? So why
idea. So basically,
why the
the
operating
idea
growth
here is
can
how
predict
you
the
should use
immediately
income
quarter
statement
in a very
to
stronger
provide
way?
useful
Why the
information
3
for
months later
investors.
is
So
weaker?
in
3 months
here,
later,
the
nothing.
example is for
Everything
investors.
disappear.
But later
Why
on,
is
you
that?
can use the income statement
Because the
to provide
assumption here is
information to managers and other people.
if it's a
So
risk, it should persist. You should
so we
always
talk
predict
about how
return
to
because
test
risk always
how
there.
what's the theory.
But if
So
it's
going back to my
because
earlier
of the
points,
skills, if you
going
know
back to my
something
earlier
other
points,
people doesn't know, the
what we
pattern should
want is
disappear.
what we
So
want is
basically, the idea here is if you
so
know
what we
operating
want
growth,
is
it's good,
you
but
use
other
these
people doesn't know it's
250
good.
variables.
Then you can
Either you have
predict
a
the
theory
next
based
earnings announcement.
prediction,
After
or you
3
have a
months,
machine learning based
people will learn
prediction.
about
Here
it's
so
theory based.
you
The
become
theory
weaker.
here is what? After another
Theory
3
here
months,
is we
people
want
will
to know
completely
that
understand it.
the
So you will
contract
see a
can be
decline pattern
renewed
over
next
year
year.
because the
And
people are
we
learning
test
what you
whether
know.
you are the person know it, other people don't
But
know it, right? This
if
is
the
the theory
return
here.
persists in the
And
future, always
and
high, that means
and
you are
we
not
talk about
knowing
different
something
ways.
other
We
people
talk
know. You are
about
just pick up the risk.
we talk
So
about how to do the
so this is
testing,
a
how to
very
adjust
important test. Normally
returns,
we
and
do
we
to
also
see
test
whether the profit
we
is
explain the
from risk
idea, the
or is
timeline,
from
and the
you
transaction
kind of
cost,
pick up
and
some
you can
information other people
understand
doesn't know.
the
So
regressions,
let me
and you
give you guys
understand the
another
profit, the green
example
line
here.
and the
So
red
let's
line.
say
So this is just one
let's say
example. This is one example how you can
let's say
use income statement
so I was
to
talking
help
to
investors. And there's millions
I
and
was
millions of
talking to
examples. You can use the income
founder
statement
security
to
a
help
couple months
investors, to
ago.
help
They
managers,
were
to help a
talking
lot of
about
people. We'll talk all about that
electronic car. They
in the
want to talk
rest of
about
class, and you
electronic
also can
car.
think about it.
So
And this is
so what they said is
about this. How
what they
about that?
said is
They want to invest in the electronic car industry because there's a
how about that
material. So there's a certain material that need to be used to produce the battery is very scarce. It's cannot be imported, cannot be imported. So what they do is they kind of invest a lot on the material that cannot be imported in order to profit from the material that is not available right now. So so over time they gain a profit next month, and in the following months they gain lower profit. The reason is because that information is also learning by others. They just learn the information uh, earlier than other investors, but that information will eventually be known by other people because this is something people will gradually to know about. It's same thing here. The operating growth is same here. What I'm testing here is the operating growth is something good. It's good stuff. So it can predict the next quarter return, but in a 3 months later, it will be lower prediction because people are learning this. Everybody is learning this. Another 3 months after, everybody will know it. If everybody know the operating growth is good, you don't have any profit. You only make profit when you know something other people doesn't know. So that's the idea here. You have to decline, the pattern have declined. So why I'm saying it has to decline? Because if every month, every quarter you make profit, that means it's not you know something other people doesn't know. That's a risk. If it's a risk, you can use that. You always predict returns. You always predict returns. So the declining pattern is important. The declining pattern is important to confirm the profit you have seen here. It's from your information advantage instead of the risk. That's one thing we do. Why we have the tradable profit or risk. Another thing is we are talking about is this is also you guys need to learn very important stuff. So how do I know this operating growth is good stuff? Normally you have to do two things. You have to predict. You use the operating growth to predict future earnings, future sales, and then you test whether other investors understand the 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 implication of operating growth for future performance and future stocks. So coming back to the example I was telling you guys, so I would say, let's say Apple invest a certain project, like invest the product. What do you need to test? You need to test this first. Does the product actually generate future sales? That's the first step you need to tell. If the product do not generate future sales, it's just scam, right? It's just a fraud. But what you need to do is the first step is you have to test whether the product predict the future sales. Once you have that, another test is are you the only person understand that, or the whole market understand that? If the whole market know the product will predict the future sales, the information is useless. But if you are the person who know the product will generate future sales, then you can trade on it. So normally we have a two-stage testing on the trading strategy. The first strategy is you have to see the signal you are testing. You have to see the product predict future fundamental value, sales or earnings. That's step one. Step two is you have to test whether are you the only person know that, or other people also know that. If everybody know this product can predict future sales, you cannot trade that. So the two steps has to be tested at the same time. So you have to test the product to predict the future sales. That have to be satisfied, and also you have to make sure you are the one know it. Other people doesn't know it. So this is one test you guys have to make sure you will do it over the project. Another way is interesting thing is you have to do is how to prove this is a profit, not a risk. Another thing is you can do something to test. You can do some cross-sectional test, or you can do some scenario test. So for example, taking back to my earlier example, I use if Apple has a product, the product can predict the future sales. Let's say I found that the product can predict the future sales, and then how do I know other people will know the same information or not? You can divide into different scenarios. For example, under the Super Bowl, you guys know Super Bowl, right? This like so under the Super Bowl case, everybody watch video, everyone watch game. Nobody take a look at Apple's financial statements. Nobody look at what kind of product Apple is doing. So in that case, if you see very stronger return, predict future return, that means you are knowing someone doesn't know. So also Friday, every Friday, nowadays Wednesday, every Friday, some of you guys think about the weekend plan. You don't want to,
closely monitoring news in the market. So if you see like a stronger results in a Friday Super Bowl, like if you see like stronger results during the time investors has limited attention, they kind of go for fun, go for holiday. If you have a stronger results that give you more confidence, what you know something other people doesn't know. You know something other people doesn't know. However, if it's not the case, if not the case, if it's not true, that means something is wrong. So so idea here is uh, how to make sure you know something, you know some signal that other people doesn't know. You can test whether it predicts the future sales. You can test the future stock returns. And another way you can test is you should see you have a stronger return in the Super Bowl period, because under the Super Bowl, everyone else doing the watching the game, getting together with the family. You are only one. You are only one looking at the Apple's 10K and find the product information. Okay, this is good. I'm going to trade on this. So if you are the one of the few person who spend time to do that, while other people are enjoying their life, and you should see stronger results. If you do that, that supports your theory you know something other people doesn't know. So these are the different ways to test whether this is whether you get a profit or risk. So everything here will be in the paper I sent you guys. We talk about that in a very detailed way, and that's why you need to we need to read the papers and the material very carefully. So to summarize, you don't use the forward-looking information. You need to calculate abnormal return. You need to farm a Macbeth, and there's a different ways to adjust for risk, and the different ways to make sure the profit is from skills, not risk, by using short window, declining pattern, by make sure the signal you use to predict future sales and other people don't get it. And also in a scenario, other people are going for game for Super Bowl, you get stronger results. That all these supports that your profit is tradable, not from risk. So these are the things you need to keep in mind when you read all this material. And let's look at one example. Let's look at one example. Uh, well, let's look at one example. The team 4 will talk about the example in a very detailed way. But I just want to give you the overview theory. What's the theory behind the example? So basically, the example will tell you how exactly you can get the information from income statement and how to do the tax and do the testing to see the future profit. So